A very good evening, friends. So, as usual, I've been asking this question almost all the class on financial instruments, and I think I can't stop myself from asking the same question again. That I hope you made your cumulative revision on financial instruments. I think we've reached quite a bit in terms of financial instruments, I guess, even in terms of the complexities. And of course, if you're thinking that are the complexities going to further increase as well, yes. But at the same time, when complexities increase, I guess it becomes even more interesting as well. So I think let's begin the journey. And let me remind you what we were discussing in terms of financial instruments. So if you remember, our focus has been on the holder, and we have decided that the financial assets is measured under which categories. When you look at the subsequent measurement in terms of financial assets, we decided a three-step model on the basis of which we decided it's AC, FPT OCI, FPT OCI, NRR, and FPTPM. Then I came to a total of three special agendas with you. As far as the accounting of financial assets is concerned, one of the agendas we discussed was with reference to the TC. And we made a complete chart in terms of the impact of TC, not only on the financial assets, but also on the financial liability. Then I went ahead with the second special agenda with you, which was as far as processing fee is concerned. And we looked into the concept of the processing fee as well in terms of both FA and FL. Wherever there is a TC or there is a processing fee, that is also going to trigger the concept of effective interest rates, especially when you're accounting under amortized cost and under OCI for FA. Because as I said, OCI category is not there in terms of financial liability. Though we are formally yet to discuss the classification of financial liabilities, which we are going to do today. But then there was a third agenda which I discussed with you. I kicked off that discussion with you in the previous class, and we are now going to take the discussion further. This is the concept of the transaction value versus a fair value. So we're going to dig deep in terms of transaction value and a fair value concept, because even if you look at the past examination questions, there have been a couple of questions on this area when there is a difference in a transaction value and a fair value. So we'll also need to understand a little more in terms of what exactly is a transaction value and what exactly is a fair value. So we're first going to concentrate on that area. Once we are covered with that area, then my next agenda for the day is discussing about the accounting of financial liability. So financial assets with the three issues will get taken care, and the financial liabilities will be taken care. Then we can go on to some more special issues which I pinpointed. That of course would be added in the next four classes: derecognition, impairment, embedded derivatives, and hedge accounting. These are going to be the four special issues to be discussed thereafter. So I think let's begin the journey and let's start. So cumulative revision is done. That's great. That's wonderful indeed, Suresh. That's brilliant. So I think with that inputs, let's now begin the journey. I am now going to take you to a very interesting chart, which is given in the study material. So I've taken a snapshot of this particular movement, which is given in the study material. So let's have a look at this. Don't get worried. The chart might look a little scary to begin with. We're going to take a couple of examples to make it very clear. So I'm reminding you, what is my issue of discussion right now? I am discussing the special issue number 3. In terms of financial assets, I'm discussing a special issue number 3, where I'm discussing the concept of transaction value versus a fair value. So first, let us give us an introduction. What is a transaction value and what is supposed to be a fair value? So let's do one thing. Let's come out of this chart and let's discuss something. So since my focus is on the financial assets right now, I'm going to give you an example also from the point of view of the financial assets itself. Now, let's consider that, let's say I have given a loan to employees. Let's say, for example, I have given a loans to the employees. Now, I'll take two variations in order to understand this concept. A similar kind of discussion we did when we were doing compound financial instrument as well. So let's take two different examples in this case. So let's consider two situations. As far as loan to employee is concerned, let's take a case number one and let's take a case number two. Now, I'm looking at the books of the employer when you give a loan to the employee. Now, when I'm going to give a loan to the employee, so what I'm going to do, I'm going to create a staff loan, or I can say a financial asset will get a debit and the bank is going to be given a credit. So from the point of view of the employer, when he's going to give a bank loan, when he's going to give a loan to the employees, so he's going to create a staff loan, which is a financial asset in the books of accounts, and the bank will be given a credit. Now, what is to be seen is what is the amount with which the entry is done. The financial asset, as you already know, is recorded at a fair value, and the bank is going to be recorded at what we can say is a transaction value. So when you're going to put the entry staff loan, that is a financial asset debit, the asset, financial asset initially is always recorded at a fair value. So let's say, for example, if you gave a loan of 10 lakh to the employee, then the transaction value is 10 lakh. But the fair value is not the amount I gave. We don't record the financial asset with the amount I gave, the amount I invested. I would say the fair value is the present value of all the interest and the principal repayment, which I'm going to get back from the employee. So I would say the fair value is the present value of all the future cash inflow. The fair value is going to be all the present value of future cash inflow, which means the interest which I'm going to get from the employee and the principal repayment which will take place at the end of the loan tenure. So one thing is very clear, that when you're going to record the financial asset, it is fair value, which is the present value of the interest and the principal I will receive in the future. And the bank gets a credit to the extent of transaction value. Now, the question rises, would there be a difference between the two or not? Now, let's consider one thing. Let's consider the transaction is, this case is case one, is made at market terms. Let's consider the transaction is made at market terms. Now, what does this mean that the transaction is made at market terms? Let's say if a loan is given to anybody, let's say the interest rate is 10%. And even in this case, let's say the employer gave a loan to the employee, let's say at the rate of 10% itself. So the rate of interest on the deal, that is what I call the contracted rate of interest, and the market rate of interest is same. So when I say that it is at market terms, it means the contracted rate, which is the CR, is equal to the market rate of interest. So as an employer, you can say that I am not giving any benefit to the employees. I'm saying, boss, if you want to take a loan, this is the rate at which the loan is given. You can take the loan at the same rate of interest. So which means the contracted and the market rate is same. Let's assume it to be 10%. Let's assume it to be 10%. So I am not doing any favor to the employees. I'm saying, boss, I'm going to give you a loan at market terms. This is the rate of interest in the market. I'm going to give you a loan at market rate of interest itself. So let's assume the period to be, let's say, 5 years. So if I calculate the period of 5 years, I can say I'm going to get on this 10 lakh interest, which is 1 lakh for the next 5 years. And you can discount this at time value of money. Discount this at 10%, which is the market rate. So I'm going to receive 1 lakh rupees at the end of each year for the next 5 years. So I took a discounting at the rate of 10% for a period of 5 years. And I'm also going to get the principal money back. And this principal money will be received at the end of 5th year. So we're going to take a discounting at the rate of 10%, which is 5th year end. Now, if you calculate the present value, if you calculate the present value of all the interest and all the principal to be received over a period of 5 years, let's see what does it turn out to be. So we can say 3.791 into 1 lakh plus 10 lakh into 0.621. And trust me, this comes exactly equal to 10 lakh itself. Now the question rises, is this a mere chance that my transaction value and a fair value is turned out to be the same? Well, I would say no, it's not a chance. The logic is fairly simple that in this case, the contracted rate and the market rate is same, which means it is at market transaction. So naturally, when you were charging the interest to the employee, you said, I'm going to take 10% from you. So, and you're discounting at 10. What you're charging is 10, and what is the rate at which you're discounting is 10. So if the transactions are entered at market terms, trust me, the transaction value and the fair value is same. The transaction value is the money which I gave to the employee today. And the fair value is the present value of all the future inflow. Since the transaction is at market terms, you will see that the transaction value and the fair value turned out to be the same. But let's imagine that if the employer was in favor of giving a concessional loan to the employee, he wanted to give a favor to the employees, would a transaction value and a fair value in this case match or not? Let's take a case number 2. Now, in this case number 2, let us consider that we're going to take a transaction at off-market term. So let's say we're going to take the transaction at off-market terms. Now, when I say it is at off-market terms, which means as an employer, I am willing to give a concession. I'm going to give an advantage to the employee. So let's say if the market rate of interest is 10%, but I told the employee, don't worry, I'm going to take only a 6% rate of interest. So there is a concession loan which the employer gives to the employee. Now let's see in this case, would the transaction value and would the fair value match or not? And we know much in advance that it's not going to match. So what do we do as an employer? As an employer, when I'm going to put the entry is staff loan, that is a financial asset gets a debit, and you're going to record this at a fair value. And the bank is going to be given a credit, and this is going to be recorded at the transaction value, which of course is 10 lakhs itself. So we're going to give a credit. The credit will be given in terms of, you can say, the credit will be equal to, you can say, the transaction value. So whatever is the amount of loan which you gave to the employee. But if I look at the fair value, can I say it would be the present value of all the interest I will receive and the present value of all the principal I will receive over a period of time. Now, in this particular case, the interest which I will receive is going to be at the rate of 6%. So on 10 lakh, you will get a 60,000 interest, but this will not be discounted at the rate of 6%. When you go to calculate a present value, you got to consider the present value of all you receive at the market rate of interest. Even if you remember, in terms of compound financial instruments, the liability was measured at a fair value, which was a present value of all the future outflows discounted at a benchmark rate, which was a non-convertible instrument. So even in this case, when I'm looking at financial assets, my benchmark rate is the market rate of interest. So what you agreed to receive is something which is contractually agreed between the parties. I can't stop the employer and the employee in terms of contractually agreeing to terms. But at the end of the day, the value of the asset is going to be a fair value. So the present value of all what you're going to receive discounted at 10% rate of interest. So 10%, 5 years, 3.791, and you're going to get the principal money back at the end of the 5th year. And let's see what is the present value coming out to be. So 3.791 into 60,000 and another 6,21,000. This works out at a total of 8,48,460. Wow. Now you can see in terms of the case number 2, there is a difference between the fair value and the transaction value. The asset is got recorded at a different figure and the bank is got recorded with a different figure, which means that this entry is not agreed and there is a balancing figure which is coming on the debit side of the entry. Now, the issue what we are discussing today is that if the transaction value and the fair value does not agree, then where do you take the difference to? That is the issue for the agenda. The special issue is that if the transaction value and the fair value differs, where is the balancing figure to be taken? I hope, friends, I am clear with the agenda. You need to be first very clear with what we are discussing. So what we are discussing is there are many transactions which can occur either at market terms or it can occur at off market terms. I've given both the extreme examples when the employer said, I'm not going to give you any kind of concession. So it was at market term. The case number 2, he said, I'm going to give you a concession. So the loan was given at a concessional rate of interest. So on one hand, when he never wanted to give a concession, the TV, the transaction value and the fair value was same, resulting in no difference in the entry. But when you're looking at a concession loan, the TV and the FV is not matching, creating a difference in the entry. So the question now arises, where do I take that difference arising in the entry? I hope I am pretty clear with my thoughts. Okay, I guess I'm getting some questions. Shruti, you said, so from the last class example, 5% coupon rate increased to 8% AIR in case of TC, example in case of that FA, yes. However, in chart you mentioned it'll decrease. Please correct me if I am wrong. Well, if you remember that due to a discount, I said it goes up. And I said due to premium, it goes up. But due to TC, it goes down. So you cannot say that 5 to 8, the entire increase is due to all 3 factors. You can say that there are 2 factors increasing, premium and discount, and there is 1 factor which is leading to a decrease, and that is the TC, right? Abhishek, so would you be discussing the disclosures as well? Are they relevant? Well, I'm not discussing Ind AS 107 because, as I said, that they're not been coming in the exams, and I think discussing all that may not be too relevant from the examination perspective. Okay, Tariq, you said, sir, processing fee is restricted between the lender. Well, generally, a processing fees would be a case where there are bank loans. So I would say it will typically apply to a case when a financial asset is taken at AC, and correspondingly in the books of the borrower, it would be a financial liability, which is again measured at AC. So processing fees is going to be common in terms of, you can say, bank loans. So we've already seen that how do you tackle that in the books of the bank, FA, and in the books of the borrower, there is FM. Okay, and that's right. And Abhishek, sir, is this the same case as a compound financial instruments? No, 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 not at all. Not at all. Well, I knew that this question might be coming to your mind, that, what is a difference in terms of a compound financial instrument and in terms of TV as well as FV? Let me clarify. In terms of a compound financial instruments, you are telling the person that are you willing to take a risk? As an issuer, you're telling the holder, are you willing to take a risk? And there is an equity element in the instrument. Because like, for example, when you were issuing optionally convertible debentures, you were telling the holder that if you want an option to convert, boss, I'm not going to give you the same interest rate which prevails on a non-convertible instrument. So you were telling the other person to take a risk in terms of the transaction, and that risk was giving rise to an equity element. Here, are you telling the other party, like the employee, to take any kind of risk? No. It is simply that the person who is giving a loan wants to actually give a benefit to the other person. So you can say that in terms of a compound financial instruments, issuer was not was not looking at giving advantage to the holder. He was telling him, boss, I will give you an option to convert. So are you willing to take a risk? So that gave rise to equity. It was not a difference between transaction value and a fair value concept. But in this particular case, what the person, the employer wants, he is saying that, okay, I'll give you a benefit. As a parent, you might give a benefit to the subsidiary by giving him loans at below market rate of interest. As, let's say, an employer, you might like to give a benefit to the employees, giving them loans below market rate of interest. So it's a conscious effort on the part of the employer or a conscious effort on the part of the parent company that they're wanting to give some benefit to the other party. And that benefit which is being given is something which we can say is indirectly like a perquisite value. So we're trying to get the difference between the transaction value and the fair value, that you're intentionally dealing at off-market term. So the concept of compound financial instrument was not dealing at off-market term, but it was telling the other person that are you willing to take a risk? This is a conscious decision in terms of dealing at off-market terms, right? I guess I am pretty clear on that, right? Okay. Now, having understood the concept, what we are discussing, so we are saying that there are two kinds of transactions. Either it happens at market terms or it happens at off-market terms. Now, I think it's the right time to take you back on the chart. Now, let's have a look at this. You will get the complete picture now. So we're looking at the initial measurement of financial assets. We're looking at the initial measurement of financial assets. It says, is the instrument at market terms? I gave you the case number 1. And I said, you're going to record it at a transaction price. Can I say in this case, the transaction price will be definitely equal to the fair value as well? As I said, all financial assets are initially recorded at a fair value. Now you might say, sir, it is written at a transaction price, but the transaction price and the fair value is going to be equal because it is at market terms. Then comes the other case. The instrument is at off-market term, which is the case number 2 in my example, that it was at market term. So you are going to record the financial asset initially at a fair value. I took the staff loan, the financial asset was captured at a fair value. So there is a difference now. So now we are looking at how do you account for the difference in this entry. I believe you've already got knowledge on Ind AS 113. I believe you've already done the concept of fair value measurements under Ind AS 113, right? Can I assume that? Of course, I can assume that. I think it goes without saying. Now, if you recall the concept in terms of Ind AS 113, I would like to remind you that in terms of Ind AS 113, there were basically 3 levels of input. There were 3 levels of input on the basis of which we used to calculate a fair value. So when a fair value used to be determined, we used to also assess that is it based on level 1 input or a level 2 input or a level 3 input. So let me just quickly take you back on the concept, what you've done in terms of Ind AS 113. Let's take a very simple example, even if you've forgotten that what was level 1, 2, and 3. Let's take you a quick recap. Let's say, for example, my company makes an investment in equity shares of a company which is listed. So I made an investment in a company which is supposed to be a listed entity. So if I want the fair value of the equity shares in which I invested, can I simply go to the market, that is the stock exchange, and get the fair value? Yes. So we can say the level 1 input is something which is observable data. It is something which is observable data, and it is something which is directly observable in nature. It is something which is directly observable in nature because you can look at the fair value of these equity share based on what is the price prevailing in the market. Now let's consider the same example. I invested into the equity shares of a company, and let's say the share of that company is not listed in the market. Then I don't have any directly observable data to look at. But let's say, for example, that a similar company is listed on the stock exchange. Let's say a similar company, the company in which I invested, a similar company is listed on the stock exchange. Then I could take the fair value based on that, and that is a level 2 input. Is it again an observable data? Yes, it is again an observable data, but it is not something which is directly observable. It is something which would need adjustments. The level 1 input data would need no adjustments at all because it is directly observable. But when you look at the level 2 inputs, we can say yes, adjustments are definitely required. Because even though a similar company is listed on a stock exchange, but there could be certain parameters on which the two companies could differ, and there might be a need to make some adjustments to that observable data as well. And sometimes, let's take an extended one, that you invested in the equity shares of a company not listed. So level 1 input cannot be derived. And it is a similar company is also not listed. So even a level 2 input cannot be derived. So what do? We go with a level 3 input and we start considering the concept in terms of estimations. So you go to the level 3 data, which is based on unobservable data. Like, for example, you want to calculate a price of the share based on a dividend discount model. For calculating the price of the share based on a dividend discount model, you will do a projections of the dividends which might be paid. So it is all based on projected estimated data. So that is unobservable. And we also said in Index 113 that this is the least reliable fair value. As per Ind AS 113 fair value measurements, we also said that it is supposed to be the least unobservable, least reliable data in nature. So when a fair value is computed, the fair value computation which is done is all dependent upon the kind of inputs which is available under 113. It can be level 1, which is directly observable with no adjustments. It can be level 2, which is observable but needs adjustments, or it can be purely based on projections and estimations, which is level 3 in nature. Now let's have a look further. He tells me how the difference between a transaction value and a fair value will be taken if the fair value is based on a level 1 input or a valuation technique that uses data which is only from observable markets. So when you are going to calculate the fair value based on a level 1 input or any kind of valuation technique which uses data based on observable market, or it says any other basis, I would say any other basis is like looking at level 3. It's like looking at level 3. So if your fair value is based on observable data, it says difference between the fair value and the transaction price is taken in the P&L. This is technically called under Index 113 as a day 1 gain or loss. Any difference which arises at the initial recognition of the financial assets is technically called a day 1 gain or loss. It's called a day 1 gain or loss. So if your fair value is supposed to be computed on the basis of observable data, any difference in the entry is going to be parked in the P&L. That's called a day 1 because it arises on initial recognition. It is called a day 1 gain or loss. And if it is due to any other basis, that is level 3, the difference between the fair value and the transaction price is either taken as an asset or it is otherwise amortized to P&L. It says it is either taken as an asset if it qualifies to be, or it is amortized. Now, how do I decide that it is eligible to be taken as an asset? And how do I decide that it's not eligible to be taken as an asset? And I am going to put it to the P&L. So what I have done, I'm now going to give you a 3-step model on the basis of which you're going to decide where am I going to put a difference arising in a transaction value and a fair value. So I'm going to give you a basic 3-step model, and then we're going to look at certain questions, and we're also going to solve these questions as well, that where the difference between the TV, the transaction value, and the FV, the fair value, is going to be captured. Sir, too technical indeed. I think financial instruments is getting technical, but at the same time interesting day by day. Isn't that so? I think so. I think so. Okay, so far so clear. So I think let me just get some quick inputs, friends. Are you able to get the clarification of this chart? So a little quick revision on that would be great. So let's, I think, give you a quick revision on this part, and let's also create a simple three-step model simultaneously. So I am now looking at the three-step model with the help of which we're going to tackle our special issue number 3. So there are a lot of three-step models which we have already used in terms of financial instruments, more coming soon in terms of other areas on financial instruments. Now, so I'm dealing with the special issue where there is a difference between a transaction value. There is a difference between a transaction value versus a fair value. So we are looking at the special issue where we're looking at the difference in the transaction value and the fair value. Now, let's see how you are going to proceed with the question. Number 1. I would say, first of all, in terms of step number 1, you need to identify that is the transaction at market terms or at off market terms. So we need to identify in a question, we need to identify that the transaction, we need to see that the transaction is at market terms or off market terms. So we need to first of all evaluate whether the transaction is at market terms or is it at off market term. So how would I consider in a question that it is at market terms or is it off market terms? Simple. If you say the transaction is at market terms, you will see the contracted rate and the market rate to be the same. Don't worry, I'll run through questions with you where I'm going to show you the data that the contracted rate and the market rate is same or not. And if you say it is off market terms, you will see the contracted rate is not equal to the market rate. So the first thing you need to make an assessment is the transaction at market terms, the CRMR is same, or is it off market term, the CRMR is different. Let's do one thing. Let's, I think, take you to some questions. I have selected a few questions from the examination and from the study material as well, where I'm going to show you the inputs in terms of different permutations combination. So let's have a look at a few examples to show you. Let's, I think, have a look, few examples to show you where we're going to look at, whether it is at market terms or not. I'm not doing the complete question at this stage. I'm just giving you the comparative position. Let's have a look. Let's have a look out here. Question number 6. It says N granted a loan at the rate of 10% per annum. It says, but the incremental borrowing rate is 12%. So I took a loan. It says I granted a loan. I granted a loan at 10%, whereas the incremental borrowing rate is 12%. So your contracted rate is 10 and the market rate is 12. So you've entered into a transaction at off market terms. By comparing this 10 and 12, we can definitely say the transaction is at off market terms. Let's see further. In question number 7, which is a November 2020 examination question, came for 12 marks. It says S advanced a housing loan to one of the employees and the interest rate is 6%. But then it says the market rate for a similar loan is 10%. So we gave a loan at the rate of 6%, but the market rate is 10%. So there is a difference between 6% and 10%, which means it is off market terms. The question will clearly give you data which will tell you that the transaction is at or off market term. So if nothing is given, of course, I will assume the transaction is at market term. Why should I assume that the contracted rate is not equal to the market rate if there is nothing to the contrary? If, let's say, the question does not give me information regarding the market rate of interest, I have reasons to believe that every transaction is supposed to be at market term. So the examiner would definitely give you inputs to decide. Let's see further. Let's see further. It says A made a security deposit and the details are given. It says market rate of interest for similar deposits is 12%. But if you look at the rate of interest being given, in this case is 0. So in this particular case, this is again a November 19 examination question. You can see this is 18, this is 20, and this is 19. Every year almost there has been a questions coming where they're testing your knowledge on, do you understand off-market terms or not? So in this particular case, the actual rate of interest being charged is 0. So in this case, again, the market rate is 12 and the contracted rate is 0. Security deposits given to your suppliers at a 0% rate of interest is an off-market term, because that interest, that deposit could fetch interest at market term. But if there is a 0% rate of interest, it is indicative, it is a off-market term. Let's see more. Let's see more. Let's, I think, show you something more as well. And let's have a look further on the question number 9. The question number 9 is a question from the study material. Now, in this particular case, we can say A issued redeemable preference shares to the parent company. And if you see, the market rate of interest is 12%, whereas the dividend rate is 0.0001%. The subsidiary company issued to the parent company preference shares, the market dividend rate is 12%, but he's paying only 0.001%. So which means it is again an off-market term. So, but then there can be numerous number of transactions which could be entered between two parties resulting in off-market term. So, sir, what is the list in terms of things? What kind of, what kind of transactions am I going to visualize and understand that if there is an off-market transaction, how do we deal? I'm going to make your life simple. Because considering the kind of questions which are given in the study, the kind of questions which come in the exam, I have zeroed down on different kind of relationships and the treatment of those relationships in terms of books of accounts. Let me go back now. So let me go back to the steps which I was creating. So we were discussing on the concept in terms of the 3-step model, but I guess you understood the step 1. The step 1 is to identify, is the transaction at or off market term? You can see in all the questions, when the contracted and the market rate is different, it indicates off market. And if it is same, so but you didn't show us a question where the contracted and the market rate is same. Well, if there is nothing given in the question, you've got reasons to believe that contracted and market rate is same. So it is only when the question gives you data, then you realize that it is off market term. So you need to identify, is it at or off market terms? So there are two possible situations which would arise. So there are two possible situations which would arise. So either you conclude that yes, it is at market term. Either you decide it is at market terms or you decide it is off market terms. Now, if you decide that the transaction is at market terms, then in that case, the transaction value 100% will be equal to the fair value. So the moment the transaction is at market terms, the transaction and the fair value will be same. So that means there will be no difference in the entry. There will be no difference in the entry. FA debit, that is the amount of fair value. Bank credit, that is the TV, no difference. But if it is off market terms, then I would say you should go to the step number 2. Then you should go to the step number 2, and then we go on to the step number 2. Now, in step number 2, you need to now identify what is the source of the fair value. Is it observable or is it unobservable data? So you need to now consider the source. You need to consider the source of the fair value computation. So you need to basically decide what is the source of the fair value. Are you considering observable input, level 1, level 2, or observable? Or are you considering unobservable data, that is level 3? So you will have two kinds of data. I would say the two kinds of data is observable. If it is observable in nature, I would say it is typically level 1 as well as level 2. Or it is unobservable in nature. And if it is unobservable in nature, I would say typically it is level 3. So depending upon the fair value is computed. Now, sir, can you take us back and tell us that where it is observable, unobservable? Don't worry, we'll go to the questions back. If you say that it is unobservable data, I will go to step number 3. If it is unobservable, I will go to step number 3. And if it is observable data, then the difference between the transaction value and the fair value is going to be called as a day one gain or loss. Is going to be called as a day one gain or loss, and it will be taken to the profit and loss immediately. Is going to be taken to the profit and loss immediately. So the moment your difference in the transaction arises and it is attributed to a level 1 input, any difference in the entry is a gain or loss, debit, credit, whatever, and that is going to be taken in the P&L. It's called a day 1 gain or loss. Then let's have a look at the step number 3. Now let's have a look in terms of the step number 3. Once you've identified that it is based on unobservable data. So once it is based on unobservable data, I would say now let's look at the type of relationship. So we will scrutinize the transaction and look at the type of relationships which are arising. And look at the type of relationship. The transactions which have occurred between the two parties will fall under majorly 3 kinds of relationship. So I would say the 3 kind of relationship could be, number 1. The first kind of relationship, what you're going to see is there could be an employer-employee relationship. There could be an employer-employee relationship. So one of the relationship which you're going to see is, there is an employer-employee relationship. The employer consciously enters into a concession loan which is given to the employee. Well, in this particular case, see the entry. The financial asset, which is a staff loan, will be recorded at a fair value. The bank is going to be given a credit, and that would be equal to the transaction value. So this will give rise to a balancing figure on the debit side. And this balancing figure is going to be treated as a prepaid staff cost. This is going to be treated as a prepaid staff cost. If you're giving a concession loan to the employees, you're indirectly giving him a perquisite, like you say in the Income Tax Act. So this perquisite is going to be deferred and amortized over the period of the loan. It's not creating an asset. It is not creating an asset, but this prepaid staff cost is going to be amortized. This is going to be amortized over the period of loan. So this is going to be amortized over the period of the loan itself. So therefore, it is treated as a deferred expense. So you're saying that indirectly it's a perquisite value. So I've given you a concession. So you are going to give me services in lieu thereof. You're telling the employee indirectly that I'm giving you a concession loan, boss. A 10% is the market rate. I give you at 6%. So that 4% perquisite value is indirectly you're going to pay me in the form of services. So let me spread it over the period of the loan. Straight line. The second kind of relationship could be in terms of a supplier, and a customer relationship. The second kind could be in terms of a supplier and a customer relationship. Like, for example, I give my supplier a security deposit. So he says that you need to give me a security deposit, but I'll not give you any interest. So when I would give a security deposit, I would put the entry security deposit will be given a debit. It creates a financial asset for me. And I'm giving a security deposit. So this security deposit will be recorded at a fair value, and the bank is going to be given a credit. And this will be given a credit at a transaction value. So naturally, there is going to be a difference because the fair value is only the present value of the principal to be received, no interest. It's an interest-free deposit. The supplier is telling you, give me an interest-free deposit. So there will be a balancing figure which would arise on the debit side as well. The question arises, where would I take this difference to? Generally, this difference which is arising between a supplier and a customer would typically occur when the relationship terminates into, culminates into a lease. And there has been some clarifications given in the education material also in terms of Ind AS 116 education material, where they've also made it clear that in this particular case, when you enter into a lease of an asset and you give a security deposit, we're going to treat this difference as a ROU asset. This is going to be called as an ROU asset. So whatever is the excess, the amount of deposit you make, the interest-free deposit is given to the lessee. So I would say the supplier and customer relationship is basically, it results in a lease transaction. So where you give a interest-free deposit to the lessor, and when you give a interest-free deposit to the lessor, then indirectly the difference in the transaction in the fair value is going to create a right of use asset in the books of accounts. So does that create an asset? Yes, it does. Yes, it does. It creates an asset. If it creates an asset, then what are you going to do in later stages? It creates an asset and it'll be depreciated over the life of the asset. In this case, it created a deferred expense which is amortized over the period of loan. In case of interest-free deposit, which is given to the lessor, you are creating a ROU asset, which will again be depreciated based on the principles of Ind AS 116. Then there can be another relationship as well, which is called holding and subsidiary relationship. There could be a holding and a subsidiary relationship. So naturally, they are related to each other. So there is a tendency of entering into off-market transactions. The parent company would like to give advantage to the company that is the subsidiary company. So let's say, for example, the subsidiary issues, as we saw, preference shares at a low rate of interest or dividend, practically zero, or the parent company gives a loan to the subsidiary and this loan is given at a low rate of interest as compared to market. So in this particular case, if this happens, let's say the holding company made a, let's say, investment in a preference share. So I would put the entry investment in the preference shares will be given a debit. And this financial asset will be taken at a fair value. So this financial asset will be recorded at a fair value. So you made an investment in the preference shares or the subsidiary. So this is going to be recorded at a fair value. And the bank is given a credit, and the bank is given a credit at a transaction value. So again, in this case, since it is a investment made at practically zero rate of interest or maybe a nominal rate of interest, so there is going to be a balancing figure which would appear on the debit side. And this is going to be considered as a deemed equity investments in the subsidiary. Because you are now investing an amount without getting any contractual right to receive anything practically. So this balancing figure is going to be treated as investment in equity instruments. It's like a deemed investments. So, but then there can be plethora of other kind of transactions as well, no? And in those kind of transactions, it could lead to different differences being treated differently. Yes. But as I said, looking at the kind of questions in the study, in the examination, I've reached a conclusion that there are basically three kinds of relationships you're going to look at. I'm not saying that this is an exhaustive list of all the relationships, but I'm saying that this is more or less going to help you in a variety of questions. You will see more or less in all the questions, it is either an employer-employee, or it is a lessor-lessee, or it is a holding subsidiary. So if it is an employer-employee, I'm going to park the difference in prepaid staff cost. If it is going to be a lessor-lessee, I'm going to park the difference in the ROU asset. And if it is supposed to be a case of holding subsidiary, I'm going to call it as a deemed equity investment. And what are you going to do with this deemed equity investment? Nothing. It remains intact. You're not going to write off this, so this will remain intact over a period of time. It's a deemed equity investments. It's more like a permanent funding. But now caution as well. This entire concept, please mind it. This entire concept of transaction value versus fair value is not applicable if there is a loan which is recoverable or payable on demand. If there is any loan either between a parent or a subsidiary company, it is not applicable if it is a loan recoverable and payable on demand. If there is a loan recoverable payable on demand, the entry is FA debit transaction value, bank credit transaction value. We do not apply the concept of fair value to loans which are recoverable or loans which are payable on demand. And there have been 2-3 questions in the exam where they've tested us that do you also know the exceptions where the concept of the transaction value and the fair value is not applicable. So this is heavy. Okay, let me now, I think, put the complete picture. We're ready to now shoot out a lot of questions with you. Let me see if there's anything coming in between. I did not look at your questions in between intentionally because I wanted to first, cover up the concept in a go. Now let me take up your questions as well. Okay, Abhishek, you said it's a difference between a transaction value and a fair value charged to the P&L in case of L1, L2 input information, right? Yes. Tahir, sir, not much clear of the question. Don't worry, I'm just going to consolidate. And could you please zoom in the question? Okay, not an issue. Okay, Kriti, off-market terms that we write. Tariq, you said, sir, it is a transaction between related parties. Financial instrument standards would apply. Yes. You see, investment in equity is not covered under this standard, but transactions between the parent and subsidiary is certainly covered under the standard. And Kriti, could you give an example for fair value computation considering observable inputs? No worry, no worry. Now it's time. I think I wanted to give you a basic infrastructure. Now, the next 5-10 minutes, very crucial. I'm going to put questions to you. I'll first consolidate the concept. I will go to the questions and you will identify what fits into which particular case. But this is one of the most important areas from the examination point of view. Let me now focus on the 3-step model which I gave you. When you proceed with a question, you need to be careful that if there is information about market terms, please hear each and every word very carefully. You'll get the entire concept in the next 10-15 minutes. Then we'll start doing questions with you. When you read a particular question, I think so far we have done questions, and I don't think so you've seen any question where there is explicit information about market terms given. So we had reasons to believe that indirectly, whatever is the contractual terms, you were deriving an effective interest rate. Now, you need to be careful when you read a question, you need to carefully see, is there information about market terms given or not? I showed you sample questions where you could see that we are clearly given that this is the market rate of interest. So the moment the question gives you a market terms, do a step number 1. Identify, compare the contracted rate and the market rate and see is it at market terms or off market term. Trust me, if the question does not give you market terms, I have reasons to believe that everything is at market term. Right? And if the question gives you a market rate of interest information, you know that if the contracted and the market term is not same, it is off market. So your step number 1 is to see, is it at market or is it off market? So the moment the contracted and the market rate is different, it is off market 1. Then you go to the step number 2. And you need to see that when I'm going to calculate a fair value, what is the source? Observable, unobservable. If it is observable, it means level 1, level 2 input both. If it is observable, though level 1 doesn't need any adjustments, level 2 needs adjustments, but it is observable. If it is observable data, then in this particular case, what I will do, I will take the difference. I will take the difference in terms of P&L immediately. It's called a day one gain, a loss. And if it is supposed to be based on unobservable data, then I will go to the step number 3, because now I need to decide that there will be a difference in the transaction value and a fair value. So I will look into the kind of relationship. Practically from the examination point of view, there are going to be 3 kind of relationship. One is there is a employer-employee relationship. One is a parent-subsidy relationship, and one is a lessor-lessee relationship. A customer-supplier who are entered into a lease, so it gives rise to a lessor-lessee relationship. If there is a difference which is due to employer-employee, you're going to call the difference as prepaid staff cost. You are telling your employees, I give you a concession loan, so the difference is nothing, but it is a staff cost for you, because you're going to get return services in return. And you're going to amortize it over a period of loan, straight line. Second, if it is a lease transaction and there is a difference, let's say you made a security deposit at interest-free rates. So this will give rise to an right of use asset, which is accounted under Ind AS 116 and is going to be depreciated over a period of the lease. And number 3, if it is a parent-subsidy relationship, the difference is deemed equity investments. That's it. Now let's have a look and get ready for some questions on this. You need to give me answers now, friends. I'm now going to run through the questions back with you. If you are able to vouch me in these questions which I'm about to show you, then I think we've got the larger picture. I will now zoom the questions as well to you. Not a problem. I will zoom these questions also. So we're going to have a look at these questions one by one. So we're going to look at these questions one by one. So let's do one thing. Let's look at question number 7 and let's look at question 8. Now you're going to apply a 3-step model very carefully. I'm going to put questions to you. Please try to answer. At the end of these run through of the 5 questions, you'll get your answers. Let's have a look at the question number 7. It says S advanced a housing loan to one of its employee at an interest rate of 6% per annum, blah, blah, blah. And then it says the market rate of interest on similar loans by the banks is 10% per annum. Number 1, I apply my step number 1. Is it a transaction at off-market or at market terms? The contracted rate is less than the market rate. The contracted rate is 6% and the market rate is 10%. So if it is a difference, it is off-market terms. Abhishek, so can you give us this question in PDF as well? No worry, you'll be getting this question in the class notes. No worry. So when you look at the step number 1, that it is off-market terms, then I go to the step number 2. I now need to see the source of the fair value. Are housing loans quoted in the market? Are housing loans similar quoted in the market? Do you get observable data to get the fair value of loans? Are they traded in the market? Or are you going to consider in this particular case that the fair value is based on the present value of the contractual cash flows? So do you think that this is the fair value of such loans are available in the observable markets? No. So it is going to be based on unobservable data. If it is going to be based on unobservable data, I will go to my step number 3, look at the kind of relationship. And in this case, I said it is employer-employee relationship. If it is employer-employee relationship, then in this particular case, you're going to treat the difference as a prepaid staff cost. Am I absolutely clear with question 7? Am I absolutely clear with the question number 7? And I think I wonderfully got the questions that it is unobservable level 3. That is perfect. So this decides with my 3-step model that this is a prepaid staff cost. Let's go ahead. Let's go to the question number 8. It says in question number 8, A made a security deposit and the details are given. Assume the market rate of interest for a similar deposit is 12% per annum. I am basically entering into a lease and I'm depositing a deposit with my lessor. I'll again go to the step number 1 and I will say, okay, is the transaction at or off market terms? We can see the contracted rate and market rate is different. And I think Tariq, you said prepaid employees benefits amortized over the period of loan. Absolutely correct. Then I go to the step number 1. I said, what is the contracted rate? It is an interest 0% interest deposit where the market rate of interest is 12%. Undoubtedly, the transaction is at off-market terms. You can see the presence of the market rate, 10%, market rate, 12%. The moment the market rate information is given and the transaction is entered at a different rate, it is an off-market transaction. I go to the step number 2. Do you think these security deposits are traded in the market? Do you think there is observable data to get any kind of security interest? No. So it is going to be unobservable data. And if it is unobservable data, I go to the step number 3 and I start looking at the type of relationship. And in terms of the type of relationship, we can see that this is a lessor and a lessee relationship. They are entering into a lessor-lessee relationship. So I know that the difference in this is going to be treated in terms of ROU asset. The lease transaction as it is creates an asset and creates a lease liability as well. So this difference is going to be attributed as a right of use asset to be amortized, rather I would say to be depreciated based on Ind-AS 116 parameters. Right? Shruti, so why in holding subsidy it is equity instrument? Nobody, I'll come to that. I'll come to that. And that's right, we said, Tariq, wonderful indeed. Now let's go to the next one. So we've done loan, employer-employee deposits, that is lessor-lessee. Let's have a look at another question as well. And let's look at the question number 9. Let's have a look at the question number 9. And we're going to look at the question number 10 as well. We're going to look at the question number 10 as well. And trust me, if you're able to do all these questions, your concepts are going good. Now let's have a look in terms of the question number 9 as well. So let me just take you to the question number 9. So let's have a look at the question number 9. And it says in question number 9, A issued redeemable preference shares to the parent company. And I can see the dividend rate is 0.0001, practically 0. And the market rate is 12%. So we are given the information. The contracted rate and market rate is different. So I go to the step number 1. Is it off-market transaction? Yes. The contracted rate is definitely less as compared to market rate. The contracted rate is practically 0 and the market rate is 12%. It is undoubtedly an off-market transaction. This is a transaction which is between the parent and the subsidiary. So where are you going to get a fair value? Are there any kind of quoted markets available for this data? No, it is unobservable in nature. If it is unobservable, you go to the step number 3, look at the relationship. And Abhishek, so not just good, but fabulous only because of you. Great, wonderful indeed. So we now go to the step number 3. What is the relationship? It is holding and subsidiary relationship. Now, I think Shruti, coming to your question, which you said, the company subsidiary issued the preference shares to the parent company at a practically 0% return. So indirectly, can I say as a parent company, I am investing money into the subsidiary and they've got no obligations to pay. You know, there are two kinds of instruments. One is a financial liability and one is an equity instrument. When the subsidiary has got no obligations to pay, that means if everything is discretionary, it becomes a case of equity instrument. So in this particular case, as a parent, you're pumping money into the subsidiary where the subsidiary has got no obligations, discretionary obligations to pay. It gives rise to an equity instruments at their hand, and therefore it gives rise to a deemed equity investment. It gives rise to a deemed investment in equity instruments in this case. So the difference is going to be treated as a deemed investment in equity. So you can see the three kind of relationship: employer-employee, lessor-lessee, holding and subsidiary, and how the three-step model is applied. Let's go further. Let's go to the question number 10. Loan repayable on demand. Is this entire concept applicable to a loan recoverable or payable on demand? No, sir. In that case, the transaction value and the fair value is same. So you can notice that I've taken the three questions in the order, filtered them out, that you've got three relationships followed by a loan recoverable on demand. If it is a loan repayable on demand, in this case, the concept of TV and the fair value does not apply. We will measure the entire FAFL all at a fair value. The concept of transaction value, fair value differences is not applicable. It is an exception. Okay, I guess you got the input. Deemed equity instruments retained in tab 1 of SOKI. No, deemed equity instruments will be reflected on the face of the balance sheet after the, you can say, in between the equity share capital and in between the other equity. So when you go to show the deemed equity, though this is asset side, this is not the liability side where I'm going to show it in SOKI. So deemed equity investment in this case would be on the asset side. But you can say if you're looking at the books of the subsidiary, he would be reflecting equity instruments issued, deemed equity instruments issued. In the subsidiary, it would appear between the share capital and the other equity on the liability side. Right? Okay, Shruti, sir, Indus 110 has got no applicability with respect to the subsidiary Indus 109. Well, let me tell you, investment in equity instruments is not covered under 109, but this is being only attributed as a deemed equity investment. We are only trying to identify that because of this transaction, it resulted in a deemed equity investments in the subsidiary. Right? Okay. So that is done. That is wonderful. Yes, this is an exception. Okay, now let's take you back to another question as well. There is a small little further question also, which I have put in, came in November 18 as well. Now let's have a look at that question as well. Because I think without that, I think our discussion is incomplete. So you can see we've got all varieties of questions, where there is going to be a day one gain or loss, where there is employer-employee, where there is a lessor-lessee, where there is a holding subsidiary, and there is an exception, loan repayment demand. All these 5 questions done, your entire section, special issue 3, done, 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 done. Now let's have a look at the question number 6 as well. Now let me just read what is the facts given in question number 6 to get the 3-step model. N granted a loan to O at the rate of 10%, which is a treasury bond yield of equivalent maturity. Aha! In this particular case, the rate of interest being charged is based on observable or unobservable data. You tell me. Okay, Shruti, you said, sir, I am not able to understand the observer level 1 and 2. Can you throw a light? Okay, no worry. You're just going to see that. I'm not done. I'm not done. Pramod, sir, if the contracted rate is more than the market rate, what is the accounting treatment? Not possible. How can the contracted rate be more than the market rate of interest? That's like siphoning out the funds out of the company. You know, if I'm going to charge you an interest rate more than the market rate, Arre Baba, that would be too much indeed, no? So if I tell the employee loan is available at 10%, I will give you loan at 12%. He will say, thank you. So technically not possible, right? That's right, I think. You would have got your answer, Shruti, now. This interest is being charged, which is based on a treasury bond rate. So the rate of interest being charged is based on observable data. And then it says the incremental borrowing rate is 12%. The loan is granted at below market rate of interest. So I apply the step number 1. Is it an off-market transaction? Yes. The contracted rate is less as compared to the market rate of interest. We can see that very clearly indeed. Then we go on to the step number 2. Is it observable data? Yes. And if it is observable, I don't need to go to the step number 3 in that case. If it is observable in data, the difference is going to be day 1 gain or loss. So we're going to take the entire difference as day 1 gain or loss in the P&L immediately. Thank you. Right, I guess, friends, I am now 100% clear. I think now we can get your comfort zone scores on the understanding of all the permutations combination. I've given you all the inputs. How do you see it is observable? How do you see it is unobservable? Then depending upon the relationships, where the differences are captured. Now I need to do one thing. I need to do these questions, but I'm not going to solve the entire questions, of course. What I'm going to do, I'm just going to create the initial entries for you. And then you can keep passing the subsequent entries, which is easy because you know the subsequent accounting in terms of financial assets, which are measured at amortized cost accounting, right? So tell me, friends, now your comfort zones on the understanding. What is your comfort zone on a scale of 10 on the concept of TV versus fair value with the exceptions? Though we had to do the questions, but I think it is great. Crystal clear, Kriti, that's wonderful indeed. 8 Shruti, that's wonderful. 9.5 Tariq, that's wonderful indeed. Beautiful. That's great. I think a little revisions would make the concept even more stronger. You will be able to get the entire inputs. Now let's do one thing. Let's, I think, start solving question number 6 onwards. So I am going to go on to the question number 6 onwards. We're just going to put the initial entries so that we get the data clear. Okay, Prashant has got 10, Mansha 9, Abhishek 9, Kriti is 9. That is wonderful indeed. As I told you, 10-15 minutes, everything will be pretty much clear. Okay, let's now move forward, friends, with you. And I am now going to solve every questions for the initial part. So let's begin a journey in terms of question number 6. I'm coming to the question number 6. And I'll pinpoint each one of them. This is case 1. And in the case number 1, I am considering the contract rate is less than the market rate. And there is observable data. And there is observable data. And due to which you're going to put the difference between the transaction value versus the fair value. And the difference is going to be called as a day 1 gain or loss. And that is going to be taken to the P&L. So this will help you in quick revisions that this is a case where we're looking in terms of CR less than MR, and there is observable data and the transaction. Let's have a look now back on the question. So the company gave a loan of 120 lakhs. And in this particular case, we need to account for the loan. Let's go back. So the entry in this case is the loan, that is a financial asset, gets a debit. The bank gets a credit. And you're going to take a difference as the difference as a day 1 gain or loss. So it's going to be taken in the P&L. Now we need to understand that when you take the financial asset, what is the value at which the financial asset is taken? Let me just properly organize the data. So when you go to look at the financial asset, I will take the present value of the future cash inflows. Let's see the future cash inflow. So the loan is for a period of 5 years. So we can say that you are going to get a 10% interest. So on 120 lakhs, you're going to get a 10% interest rate. This is going to be discounted at the rate of 12% for a period of 5 years. And you're also going to receive that principal amount at the end of the 5th year, discounted at 12% at 5th year end. So we are considering that what is the present value? You're going to get that 12% interest, 10%, 12 lakhs interest every year for the next 5 years. And then you're going to get the principal money at the end of the 5th year. The discounting rates are already given. So let me just pick up the discounting rates. It is 0.892, 0.797, 712, 636, and 567. So this is 3.604. This is going to be 3.604. And let's also consider the fifth year, 0.567. So I guess we can easily calculate this value. And as far as the bank is concerned, this is going to be at 120 lakhs, which is the transaction value. So this is the fair value and this is the transaction value. Let's, I think, calculate this. I think I've done the calculations as well. I'll just give you, save time on that. 111, this is coming to 111.28 lakhs. This comes to 111.288 lakhs. So this is the fair value. And you're going to get a balancing figure. And that balancing figure is going to be the day one gain or loss. And that would be taken in the P&L, simple and straight. So the difference you're going to get is 8.712. The difference is 817.2 lakhs. That is how the entry will be done at the initial recognition. Thereafter, if you ask me, how would the financial asset be accounted for? Though the question is not asking you to do that. But I guess this is going to be accounted at amortized cost. And you know how the accounting at amortized cost is done. Not a big deal. Though not required in the question. So that takes care of the question number 6. Now let's go to the next question with you. So that was simple, just little calculations. Okay, Satish, I think you said, so what is the measurement base for deemed equity investments, FPD, OCI, NR, or no impact of the fair value change? Well, I think it should be considered based on Ind AS 27. Because when you're making equity investments in the subsidiary, we already said that, the concept of the financial instrument standard is not applicable. Financial instrument standard applies only to unrelated party investments. So this is going to be accounted at a cost itself. So the concept of fair value would not apply, right? Okay, so let's go further. This was question 6. Now let's have a look at the question number 7. So let me just quickly go to the facts. It says on 1st April 2020, S advanced a housing loan 15 lakh to the employees at an interest rate 6% payable in 5 equal annual installments along with interest. It says you're going to pay interest 5 equal annual installments along with the interest at the end of each year. So it is paid in 5 equal annual installments along with interest means that it is going to be in 5 equal principal installment. Get this clear? So it says 5 equal installments along with means plus interest. So the loan is going to be paid in 3 lakhs each. Employee is not required to give any specific performance. Well, it doesn't make a difference whether the employee is required to give a specific performance or not. Then he says the market rate of similar loans is at the rate of 10%. The accountant of the company recognized the staff loan in the balance sheet at 15 lakhs. The interest income is taken 6% on 15 lakhs. So he's done all wrong accounting. He first of all took the staff loan at a transaction value. Secondly, he recorded the interest based on the transaction value itself, which is wrong, though we need to account using the effective interest rate. Analyze whether the above accounting treatment made by the accountant is in compliance with the Ind AS. Of course not. If not, advise the correct accounting treatment. Interest and other expenses in the financial statements for the year 2021 along with the applicable Ind AS. You're required to show the loan as would appear in the balance sheet on 21. I think I'm going to give you the initial entries and then the subsequent accounting is going to be simple. So let's go to the question number 7. So let's have a look at question number 7. So if I look at the question number 7, it is supposed to be a case number 2. And in terms of case number 2, the contracted rate is less than the market rate. It is supposed to be unobservable data. And based on the unobservable data, we'll look at the relationship. It is employer-employee relationship. It is employer-employee relationship. And based on the employer-employee relationship, we decided that the difference in the transaction and the fair value is going to be treated as a prepaid staff cost. So we're going to treat the difference as a prepaid staff cost. So let's give you the initial accounting entry highlighting the CR is less than MR, unobservable employer-employee relationship. So let's see the entry. We're going to put the entry staff loan gets a debit, which is a financial asset. And the bank is going to get a credit, which is on the transaction value. And we're going to get a balancing figure. Let's, I think, record it initially. That is a prepaid staff cost. So let me just organize the data in terms of the present value so that everything gets sorted. So let's, I think, consider the staff loan, which is going to be taken at a fair value, which is equal to the present value of cash inflows arising in the future. The bank is, of course, going to be based on 15 lakhs, which is the transaction value. So now we need to consider the present value of this loan. So let's now take it further. The loan is for 15 lakhs and we're going to get money in 5 equal installments along with 6% interest. So be careful now. So if you want to calculate the present value of the inflow, we can say what are the inflows over a period of 1, 2, 3, 4, 5. Because there are different inflows arising at different points in time. So can I say you are getting an inflow of 3 lakhs every year, principal. You're getting a principal of 3 lakhs every year in this case. Because he very clearly says that this is payable in 5 equal installments along, that means plus the interest. So now we need to consider the interest as well at the rate of 6%. Be careful now. Can I say the interest in the first year is going to be on the outstanding balance? Second year is again going to be on the outstanding balance. So we can say the loan outstanding in first year is 15 lakhs and 6% interest would mean 90,000. Now, since you have made a repayment of 3 lakh, the interest will also keep falling down. So it'll be now on 12 lakhs at the rate of 6%. So keep reducing it by 18. So this is going to become 54. This is going to become 36. And this is going to become 18. So as an employer, you are going to get these inflows over the period of next 5 years, and you need to discount this by using the present value interest factor, which is at the rate of, let's see what is the rate of interest in this case. So the market rate of interest in this case is 10%. So you're going to discount this at the rate of 10%, and you're going to get the present value. I already have the present value with me. So I'm just going to share the present value of the loan. So if you do the discounting, it comes to 1354. This is 13,54,602. So we can fit into this. This comes to 13,54,602. So you can take a balancing figure that is a prepaid staff cost. Computations, but otherwise the concept is easy. So when we take the difference, 15 lakhs minus 13,54,602, this balancing figure is 145,398. And this amount is going to be treated how? Can I say this amount is going to be spread equally? This is going to be spread equally over 5 years. So you're going to charge this amount straight line basis over a period of 5 years in the profit and loss account as a staff cost. And how do you tackle this staff loan? This is going to be accounted at amortized cost accounting, which you already know. So if I were to make the ledger accounts of this FA, you're going to do this at AC. So every year you can say in the books of the employer, there will be a interest on the staff loan as an income, and there will be a prepaid staff cost on the other hand appearing as an expense. So he will have the amortization of that expense, and he will have a finance income over a period of 5 years based on the interest rate 10%. Wow, I guess that is also pretty clear. Okay, Satish, your doubt is clear. Great. Kriti sir, if the fair value is computed as per observed data, then there may be another method of fair value computation other than the present value of inflow. Well, I guess I'll not get into the insights in terms of Index 113 that, what can be the different permutation combinations. I guess I'm just looking at the fact, whatever I need for 113, that if it is observable, day one gain loss, unobservable, relationships, and the difference is accounted. Okay, so that was case number 2. That was case number 2. Now let's go to the case number 3. So now let's go to the case number 3. I think I just need to take it above. So let's go to the question number 8. So let's have a look at the question number 8. I think I need to clear this a bit. So this is the question number 8, which is pertaining to the lessor and the lessee relationship in this case. Let's have a look. So in terms of the question number 8, I am given A made a security deposit, make the journal entries, and assume the market rate of interest is at the rate of 12%. Okay, so in this case, there is an interest-free deposit. Let's go to question number 8. Let's add a question number 8 out here. So we've got question number 8, which is case number 3. This is a case number 3 where the contracted rate is less than the market rate. There is unobservable data. And based on this unobservable data, we're looking at a lease that is a lessor-lessee relationship. So we're looking at a lessor-lessee relationship. And in this particular case, the difference is going to be attributed to the ROU asset. The difference is going to be attributed to the ROU asset. I will advise that, you must do all these questions, though I'm doing the initial entry. You must do all these questions in a complete go. It'll also give you good practice in terms of the financial asset ledgers made at AC, the presentations in terms of the financial statements, how it would appear in the balance sheet, or what expense incomes would appear in the income statements as well. Okay, so this is contracted rate less unobservable. Let's look at the entry. So we can say we've got a security deposit. We can say that we've got a security deposit that is nothing but a financial asset. And we've got a bank figure. And this will be given a credit. So you're going to get a balancing figure that is ROU asset. So that would be a balancing figure in this case. So let's do the honors and let's do the calculations as well. So as far as the bank is concerned, this will be at the transaction value. So I guess the transaction value is 10 lakh. So we know the 10 lakh is the transaction value. And if you're looking at the security deposit, we're going to consider the fair value, which is the present value of the cash inflow. So there is no interest which is appearing, actual interest which we're getting over a period of time. Only the deposit comes back to me after a period of, I think, 5 years. So the discounting factor is 0.567427. So this is 0.567427. And we multiply that 10 lakhs, which we're going to get after a period of 5 years. So the only inflow you're getting is the present value of the principal deposit back. So this is 0.567427 into 10 lakh. So this is going to be 567. This is 567,427. And you get this as a balancing figure. And that works out at 432. That is 432,573. So this is going to be again accounted at amortized cost accounting. And what happens to the ROU asset in this case? Can I say it will be depreciated over the lease term? It's going to be depreciated over the lease term. And that would be as per Ind AS 116 principle. So this is going to be depreciated based on the principles what you've learned in terms of Ind AS 116. Right. Okay, so that is great. So this is the case number 3, which is done as well. Let's go to the case number 4 now. So let's go further. Let's go to the case number 4. Okay, now in terms of the question number 9, which is the fourth case, I think once you understand the concept, then it's just a little, clerical computations indeed. Otherwise, it is pretty easy. Okay, it says A issued redeemable preference shares, and in this case, no dividend is being paid with a subsidiary, and the market rate is 12%. Let's organize question number 9. So let me organize the question number 9 as well. So question number 9, I think that is case number 4. So this is case number 4. And in this case, again, the contracted rate is less than the market rate. And it is again unobservable data. It is unobservable data. And the relationship is in terms of holding and subsidiary. So this is going to lead to a difference. And the difference is going to be called as a deemed investment in equity instruments of the subsidiary. So that is the case 4, where the difference is a deemed investment in equity. So let's put the entry. In this case, he is making investment in preference shares. So there is an investment in the preference shares of the subsidiary that gets a debit, that is a financial asset. The bank gets a credit that is at a transaction value, and you're going to consider the balancing figure, which is investment in equity instruments, and that is a balancing figure. And nothing is going to happen to this deemed equity investments, unlike the prepaid staff cost, which is amortized, unlike the element of RU asset, which is depreciated. This remains intact. So in this particular case, we can see what is the transaction value. I guess the transaction value in this case is 100 lakhs. Is it 100? No, it is 1000 lakh. So this is 1000 lakhs is the bank figure. This is supposed to be the transaction value. And this investment in preference shares will be taken at a fair value, which is the present value of cash inflows. So that is going to be the present value of the cash inflows. And the present value of the cash inflows is, you're going to get this money only at the end of the 5th year. That is 0.56743. 0.56743 into 1000 lakhs. This is the only money which we are getting. So that is the present value of the inflows. So 0.56743 into 1000 lakhs. And this comes to, I think, in terms of lakhs, 567. This is 567.43 lakhs. So we get a balancing figure which is to the extent of 432.57 lakhs. And again, this investment in preference shares will again be accounted at amortized cost itself. And what happens to the investment in equity instruments? It would remain intact. It is not going to be, amortized, or it's not going to be depreciated over a period of time. Wow. So case 1, case 2, case 3, case 4 is done. Day 1 gain loss is done. Then employer employee, then lessor lessee, and holding subsidy. Now comes the exception. Let me see if any questions coming in between so far. I think it's all good, all set. Okay, now finally, let's go to another case number 5, which is a case of exception. Let's have a look now at question number 10. Let's have a look at question number 10. So we're going to make a run through on this question, because this question is, I think, there in the study material as well. And this particular question is also come in the exams, I think, twice as well. So it came in the RTPs, it came, I think, in the exams as well. Let me just read the question to you. It says K granted an interest-free loan to its wholly owned Indian subsidiary. There is no transaction cost attached. The company has not finalized any terms and conditions, including the applicable interest rate. The board of directors of the company are evaluating various options and requested your firm to give views under Ind AS in the following situations. Now, there are a total of 3 situations given. The loan given by K to its wholly owned subsidiary is interest-free, and such loan is repayable on demand. Now, interesting thing, friends. If there is a loan which is on demand, number one, the concept of transaction value, fair value is not applicable. Number two, are you going to record any interest income or interest expense in the books of accounts of the parent subsidiary? No. The moment it is a loan recoverable or payable on demand, the only entry is FA to bank, and then when you receive, bank to FA. No interest accounting, no transaction value, fair value accounting. And in the books of the subsidiary, you can say it is bank debit, FL credit. And then when you repay the money, then it is FL debit and bank credit. So the accounting in terms of a loan, recoverable, payable on demand, becomes simple. No differences in transaction fair value attributed. 1. No interest income expense to be recorded. Number 2. Then he said the said loan is interest-free, but it is repayable after 3 years. If it is repayable after 3 years, it's not a loan repayable on demand. Will the concept of transaction value and fair value differences apply? Yes. So are you going to get a deemed equity investments in the company? Yes. Are you going to consider the interest, income and expense? Yes. Don't worry, I'll document that. And then it says the current market value, the loan is given, and he's already given you the fair value as well. The loan is interest-free, will be repaid as and when the company has got funds. If you say that the loan will be repaid as and when the company gets fund, it is not payable on demand. Then the treatment of point number C and the point number B is going to be exactly same. Let's do one thing. To the question number 10, let's add on some interesting notes to you. So let's go to the question number 10 and let's add the case number 5. And along with this case number 5, let's, I think, give you an interesting chart from the parent and the subsidiary, both perspective combined. So I think I'm going to make an interesting chart in this case in terms of question 10. And I'm looking at the 2 situations. One is that if it is a loan which is payable, recoverable on demand, and one is it is not recoverable, payable on demand. So we're looking at 2 situations. Situation number 1, where we are considering it's a loan which is recoverable or payable on demand. And we're looking at situation number 2, where we are saying that it is not a loan which is recoverable or payable on demand. So there are 2 different situations, either recoverable, payable on demand or not. Now let's, I think for clarity of thought, let's also look at the entries in the books of both the parent and the subsidiary. So I'm assuming in this case that the loan is given by the parent to the subsidiary. So let's consider the loan is given by the holding to the subsidiary. So let's see the accounting in the books of the holding. Let's see the accounting in the books of holding, and let's see the accounting in the books of the subsidiary to get a clarity of thought under situation 1 as well as under situation 2. Now, in this particular case, watch the entries carefully. If you say the loan is recoverable on demand, he puts the entry financial asset debit, and he puts the entry bank account credit. This is going to be recorded at transaction value only. This is going to be recorded at a transaction value only. The concept of transaction value, fair value is not applicable. 1. Second, are you going to record any finance income? No. So today you gave a loan. This is the entry. No finance income to be attributed at the end of each year. When you receive the money back, reverse the entry, done. Now let's consider the books of the subsidiary. He has taken a loan, so he puts the entry bank account debit. and a financial liability gets a credit, and this is again going to be taken at a transaction value. The concept of transaction value, fair value difference also not applicable here. Is he going to record any finance charge over a period of time? The answer is no. Practically, you will see, if you do work on the index, you're going to see that many companies, parent, subsidiary, enter into loans with each other, which are recoverable, payable on demand, in order to safeguard themselves, that they don't have to attribute any finance charge or finance income, because in any case, the standard setters were also happy. Because even if you attribute a finance income or charge in the books, from the consolidation point of view, it's going to be zero. So why trouble them? If they're interested in dealing with each other on loan, recoverable, payable, and demand, let them live their life. The logic was simple. Because in this particular case, even if one company records a finance income, another records a finance charge, in the consolidated profit and loss, it's going to be zero. So what's the point? So they said, if it's a loan recoverable, payable on demand, let's forego the transaction value, fair value difference. Let's forego the finance income and the finance charge. But if you come to the concept that the loan is not recoverable on demand, now watch this. He will put the entry financial asset debit at a fair value. He's going to record the entry financial asset gets debit at a fair value, and the bank gets a credit, and the bank gets a credit at a transaction value. So there is going to be a difference in the entry. And the difference is going to be investment, which is deemed equity investments as a balancing figure. So he is going to put the entry FA, which is the loan, and the deemed equity investments as a balancing figure. And in this case, are you going to record the finance income in the books of accounts? Yes. You're going to account for this financial asset at amortized cost accounting. This financial asset is going to be recorded at amortized cost accounting, and a finance income is going to be attributed as well. And if you correspondingly look at the entries in the books of the subsidiary, then he would put the entry bank gets a debit, which is going to be at a transaction value. And the financial liability gets a credit, which is going to be at a fair value. So now the question rises, what is the amount he is going to put in the books of accounts? Because there is going to be a balancing figure on the credit side, and this is going to be called as equity contribution. So we're going to call this as an equity contribution in this case. So it is like that he is increasing his equity. He is investing in the deemed equity. The subsidy is recording, there is increase in the equity contribution, and this is investment. And is he also going to record a finance charge in the books of accounts as well? Yes. The financial liability is going to be recorded at amortized cost accounting, and a finance charge will be attributed. So you can see a comparative position. So this is the case which is the exception. This is the case which is the exception, the case number 5. The case number 5, where the exception, where the concept of TVFV does not apply. But I wanted to give you a complete picture that if it is a loan which is recoverable, payable on demand, then the concept of TVFV not applicable, finance income charge not applicable. But if it is not recoverable on demand, in those particular cases, the concept of TVFV would apply. The finance income and charge will be attributed, though in the consolidation, this will get eliminated. So very heavy. But this, I think, takes care of a larger special issue in terms of financial asset. Wow. So we are now done with the entire accounting in terms of financial assets. We have covered the accounting in terms of FA, and we have covered the special issues, the TC, the processing fee, the transaction value versus fair value. And now it's time to go to financial liabilities accounting. But I think before that, we need to give you a break as well before we go on to the financial liabilities accounting. Okay, let me see if any questions coming in so far at this stage. And I think Abhishek tells me, not heavy, sir. It's becoming interesting now. Beautiful. It's going to get more interesting, trust me. The next four sessions on financial instruments is going to be very interesting indeed, especially the concept of derecognitions, embedded derivatives, hedge accounting, where I have a lot of things to tell you, and it's going to become very interesting indeed. Right, friends. So I think now it's time to give you a little break as well. I'm sure you need one. So I think let's take a 10-12 minutes break and we commence back with this. We're going to start our accounting on financial liabilities after the break. Enjoy your break. So I hope you had a relaxation of mind, though quite a lot of inputs to be remembered. So I think let's now take the journey forward with you. Let me see if there is any question, then we can go further. Okay, looks good. Okay, perfect. Yes, sir. Heavy increases the weight of interesting as well. That's wonderful indeed. Okay, now let's, I think, go further and we're going to focus on the financial liabilities with you. Our focus has been on the financial assets so far. Now we need to focus on financial liabilities. So let me first, I think, focus in terms of accounting categories. I think I'll just like to first remind you back again. Let's, I think, remind you once again on certain things. Let's get the chain of thought very clear, because as we proceed, we need to be very clear on the agenda. Now, watch this carefully. I'd given you this inputs earlier as well, but I just need to get it very clear before we go forward. Your mind has to be very clear that how are you proceeding in terms of financial instruments. So just a quick look into things. So how are you going to look at a mind map in terms of remembering things? We looked at the issuer perspective, and the focus out here was in terms of Ind AS 32. So when you're looking in terms of the issuer, we went into Ind AS 32, and in this case, we were using the concept of a three-step model. And with the help of the three-step model, which I gave you a version 3.0, we decided that the instrument ultimately falls into broad three categories. So in this case, we decided that the instrument in this case falls into three broad categories. One is, we said, it is equity instrument. One is, we said, it is FL. And one is, we said, it is compound financial instruments. Now, the main issue was that when it comes to equity instruments, the entry would be simply bank account debit, the equity share capital gets a credit, and this is the end of the accounting. Maybe there is a security premium on the issue of the shares as well. So there is no accounting which is, complicated, any kind of accounting on equity instruments issued by the company. So therefore, we have not really talked of this, and neither are we going to talk much on this as such. Now comes the focus in terms of financial liabilities. If you ask me what is the value at which it is initially valued, it is supposed to be at a fair value. Just like, remember the case of financial assets, that they are initially taken at a fair value, and subsequently you've got different categories. The initial recognition is at a fair value, but is there any exceptions which are there? And let me tell you, just like financial assets, there are two exceptions here as well. If you've got trades payable, that is creditor, or if you've got a loan which is payable on demand, then in that particular case, we record things at a transaction value. So these are the exceptions where you're going to record things at a transaction value. Then comes, how would you treat the financial liabilities subsequently? How would the subsequent accounting take place? This is what we are going to cover now. So this is what we're going to cover now. So you need to remember that financial liabilities initially will be taken at a fair value, with these exceptions where the accounting is done at a transaction value itself. And now we need to see what is the subsequent accounting of financial liability. Now, before we come to that, let me just complete the chain of thought as well. In terms of compound financial instruments, we did our split accounting, and we've also seen in detail all the kind of accounting as far as CFI is concerned. So we covered in detail, the concept of a perpetual loan. I gave you the complete accounting for a perpetual loan. I gave you the accounting for optionally convertible instruments, partially convertible instruments, mandatorily convertible instruments. So we covered the entire detail accounting. And if you remember, I also covered the aspect of how the transaction cost is accounted for. So I also gave you as a special issue that if there is a TC which triggers an EIR, if that is not given, how do you calculate, how do you apportion, everything was taken care. So now we are focusing on this area. The other part is what we discussed was the holder. The other part is what we discussed in terms of the holder. So just to remind you that this entire accounting of FL is covered under Ind AS 109. The entire accounting in terms of CFI was covered in terms of Ind AS 32. Therefore, we did not cover this part because the accounting measurement of this is covered under 109. So we covered that part, but this part was left pending because it is addressed by 109. Now, in coming to the holder's point of view, we focused in terms of Ind AS 109. We focused in terms of Ind AS 109, and in terms of the Ind AS 109, we again decided that if you're looking at the initial measurement of the financial asset, because here we are focusing in terms of financial assets, and again we said that the financial assets initially is taken at a fair value, but here also we said that there are exceptions. Here also we said that there are exceptions, and the two exceptions is if it is a case of a trade receivable, or there is a loan which is recoverable on demand, then these are recorded at a transaction value and the concept of fair value is not applicable. Now, when we went to the subsequent accounting, in terms of financial assets, we had categories like AC and FPTOCI that was R, or it was FPTOCI that was NR, and it was FPTPL. So these were all accountings which were meant in terms of subsequent accounting. And after we did all this, I gave you a deep inputs in terms of how the accounting under OCI, AC, R, NR, everything is done, including the movements of tab 3, tab 2, etc. Then we came on to the special discussions with you. In this case, I came to certain special issues of discussions with you, and I organized my special issue discussions in 3 parts. I said, let's first focus on the transaction cost and how the TC is going to be taken as a part of FA under different categories. How would it trigger the concept of EIR, especially in terms of AC, OCI? And similarly, in terms of the second special issue, we covered the concept of processing fee, and we also covered the concept of transaction value versus a fair value. And let me also remind you that when I did this concept of subsequent aspect, here again, I gave you a 3-step model which decides the category, of which investment is done. And here again, in terms of the special issue, I again gave you a 3-step model. So you can see that there are a total of 3 places where I've given you a concept of a 3-step model: Ind AS 32 issuer perspective, Ind AS 109 holders perspective, and in terms of transaction value and a fair value. So now out of this entire chart, our main focus now, which we are discussing now, is this area. Rest all this particular chart is got covered. And I've already told you that apart from this chart, what are the other agendas in terms of financial instruments? The main areas are derecognitions, impairment of financial assets, derecognition of both financial assets and liability. Then in terms of impairment of financial assets, then there is embedded derivatives accounting and the concept of hedge accounting. So these are the 4 agendas after this. So let's now focus on the subsequent accounting of FL. That brings everything into light, and I think that gives us well. Okay, I think Shivansh, so I recently started watching ICAI recorded lectures and just loved your classes on Ind AS 115. Just came here to say that you're a terrific teacher. Thank you, Shivansh. Shivansh, that's really sweet of you. I think you're coming in just to say that word means a lot to me. I am more than delightful. I feel blessed on that. Thank you so much. Okay, and Abhishek, the mind map was much indeed required. Okay, so I think that was the right timing to give the things so that everything gets embedded. I know that when the topic gets, too technical and there are so many inputs in that, it is very much required that, you are able to consolidate all the learnings timely as well. Okay, now let's go to the financial liabilities discussions with you. And now comes a very interesting discussion. Now comes a very interesting discussion. So let's have a look at this. This is going to trigger a couple of thoughts as well. Now, this is going to be a little more technical, but don't worry. There is one particular portion which is technical, which I will not cover right now today. I have another questions, though I thought, today initially I'll be doing some questions with you, but I kept them pending for some time. And they were very interesting questions which came in the exam. And that was dealing with financial assets which are invested in a foreign currency. Wow. Interestingly, there have been two questions in the RTP. And if you ask me frankly, I think the level of questions of collections which are given in the study material, RTPs, and the examinations, is such brilliant kind of collection that after doing those questions, your level of clarity further increases. So once you're able to get a grip in terms of the concept and then do practice of questions as well, trust me, you'll feel much more confident in terms of the topic as well. Okay. So we might discuss that issue in terms of financial assets which are measured at a foreign currency. How does that accounting take place? There is one question which is on a FL, and there is one question which is on a FA, which is in a foreign currency. Beautiful questions. I've just also kept them in the class as well. Let's see if you get time, we'll come to that. But let's begin with the FL now. So let's have a look in terms of financial liability. Upon initial recognition, all financial liabilities are measured at a fair value, but I give you exceptions: the creditors, the trade payable, and the loan payable on demand. Then he says, subsequently, the classification of financial liabilities are as under. Now, please hear me carefully. Now, please hear me carefully, because you may not be able to understand certain terms at this stage, because one or two terms are very different. Now, when you consider the categories of financial liabilities for subsequent classification, broadly, if somebody will tell me that how many categories are there, I would say there are two. I would say the financial liabilities are either taken at AC or they are taken at FPTPL. There is nothing called FPTOCI in terms of financial liability. So either it is measured at amortized cost or it is measured at fair value through P&L. The default category in terms of financial liabilities is amortized cost accounting. Now let's have a look. It says the classification of financial liabilities is it is measured at amortized cost. This is one. It is measured at FPTPL. Fair value through P&L is FPTPL, and that is two. And that is two. Now, can you see that within this there are two items which are given? Liabilities that meet the definition of held for trading. If you've got liabilities which are HFT, just like equity, if you've got any FL which are HFT, they're measured at FPTPL. And if you remember, there is a contingent consideration which is paid by the acquirer in a business combination. Remember the concept of CCS in terms of Ind AS 103, where if you remember, I gave you the inputs that the contingent consideration, if it is paid in cash, is called FL as per financial instruments. Oh, yes. We remember, sir, you telling us, and I said, you're going to get more details when you come to financial instruments. If you remember the concept, what we discussed under Ind AS 103, we said if the contingent consideration is paid in cash, it is a financial liability. And if the contingent consideration is paid in shares, it depends upon whether you are issuing fixed shares or variable share. And if it is supposed to be fixed shares, then it is called an equity instrument. And if it is variable shares, it is called an FL. And if you remember, we said if it is paid in cash, it is a financial liability. And if it is paid in shares, then also it is a financial liability. And I told you that you need to remeasure this amount at a fair value on the balance sheet date. The reason is that if you're taking this financial liability and this financial liability, it is going to be taken at FPTPL. So two kinds of financial liabilities are taken at FPTPL. One is which is held for trading, and one is, you can say, derivative liabilities, I would say. So one is held for trading and one is the contingent consideration, which is paid under Ind AS 103 in terms of either cash or in terms of financial liability. Then it says there is a third category which is designated at FPTPL. It is designated. The companies under Ind AS have got a choice at times, but it is not a free choice, but it is a conditional choice. And I'll just explain in very simple words, where does it become conditional in nature? Let's say, for example, you are funding certain assets by liability. So let's say, for example, you are funding certain assets by certain liability. Now, let's say these financial assets are measured at FPTPL. So if you're funding those assets by financial liability and the financial assets are measured at FPTPL, the changes in the financial assets will be captured in the P&L. And if you designate the FL also at a FPTPL, so what will happen? The changes in the FA goes to P&L, the changes in the FL also goes to P&L. So it gives you an offsetting advantage, because increase in the asset would mean a gain and increase in the liability would mean a loss. So a gain and loss entering the P&L gives an accounting advantage. It gives you an offsetting advantage. So there are certain cases, without getting into depth, you can say where the company has got certain conditional choices. And they can say that I am not going to measure the FL, let's say at AC, but I've decided that I am going to, designate and decide that you're going to measure it at FPTPL. Now, another question would come to your mind. So in the second category, you're saying that the liability is measured at FPTPL. In the third category, also you're saying that it is designated at FPTPL. So can't we club the two categories and say that, financial liabilities which are measured at FPTPL is held for trading, derivative, contingent considerations, and even those which are designated at FPTPL? No. Now, please hear this further clear. The accounting treatment of these two financial liabilities is not the same. I know what I'm saying is very technical indeed. So the accounting treatment of these two financial liabilities is not the same. If a particular financial liability is classified as FPTPL because it is held for trading, then the accounting is different. And if a liability which was supposed to be measured at AC is designated to be measured at FPTPL, the accounting is different. What is the difference in accounting? I'll very shortly tell you that. Okay, then I think we are looking at other specific measurements. Let's leave that. And then comes further. So this is the fourth one. I think let's come to the fourth one out here. So then I'm leaving this. I'm coming to this number 4. So this completed the list of 3. Now I'm coming to the list number 4. Now, there is another interesting liability as well, and this is called financial liabilities that arise when a transfer of a financial asset does not qualify for derecognition or when the continuing involvement approach is applied. Sir, आपको दया नहीं आती? नहीं आती. It reminds me that if I am going to have mercy on you on how much you can learn, I can't teach you, It reminds me, the concept of, what the person said in Munna Bhai MBBS, that if I start loving my patients, I can't treat them. So it also reminds me, that if I trust you, I feel that, you're small children and I should love you all and not give you pain. Then no pain, no gain. So in any case, if you want to learn further, yes, there is going to be pain. So don't worry, I will consolidate all this input further, but see what it says. Financial liabilities that arise when there is a transfer of a financial asset which does not qualify for derecognition. We're going to do this tomorrow. So don't worry, we're going to do this tomorrow. You're going to understand this tomorrow, that what is a financial liability when you transfer a financial asset and it doesn't qualify for derecognition. So we're going to understand that in derecognition or when a continuing involvement approach applies. Then he says, number 5, there is a financial guarantee contracts. There is a financial guarantee contracts. I'm not reading further. If somebody were to ask me that don't disturb my mind and just tell me in simple words what are the categories of FL, I will make his life simple and I will say, boss, there are 2 kinds of FL. Please hear this carefully. I'm going to tell him, boss, there are only 2 kinds of FL. One is measured at AC, one is measured at FPTPL. Unless mentioned otherwise AC. If the question says FPTPL, do FPTPL. Thank you. But if the other person says, no, I want a deeper knowledge and I want to understand the various categories of FL. So I will say, boss, there are 5 kinds of financial liabilities. For the purpose of subsequent measurement of financial liabilities, I would say there are 5 kinds of liability. Number 1, measured at AC. Number 2, which is measured at FPTPL. Number 3, which are designated to be measured at FPTPL. They're not originally decided to be measured at FPTPL, but they are zabardasti designated to be measured at FPTPL. A financial liability which is measured at FPTPL has got a different accounting, and what is zabardasti designated at FPTPL has got a different accounting. Number 4, we can say there are certain liabilities which arise on account of derecognition concept related to FA, which we'll cover tomorrow. And number 5, we can say there are financial guarantees. Sometimes in practical life also, you will see that a parent company guarantees the loan taken by the subsidiary from the bank. And these financial liabilities are called financial guarantees, and they are also measured at a fair value. There was a question in the RTP where they've specifically asked for accounting of financial guarantees. So we're going to cover that question as well, where the accounting for financial guarantees is done. So 5 kinds of liabilities which you need to study. Number 1, AC. That you know how the accounting of FL at AC is done. Number 2, FPTPL. That you know differences in the fair value taken to the P&L. Designated at FPTPL, we don't know. We will do that. Financial liabilities arising due to derecognition of FA will cover tomorrow, and financial guarantees will cover later. So right now the focus is what? We need to understand the financial liability designated at FPTPL. Okay, let's now take it further. Okay, so I guess Abhishek, more of a cumulative revisions helps the most. That's great. Shruti sir, how do you remember all this in a single go, and that too with linking with other Indias as well? That's a good question indeed. I had a passion in terms of learning these Indian accounting standards. And trust me, I qualified way back in 1999 when there was nothing called Indian accounting standards. And passion puts you under a lot of charm in terms of learning new things as well. And when it puts you a lot of charm and when you start doing a lot of practical work also, it definitely gives you a lot of help as well. And I think it's always the intention and the ability which is important in terms of doing things. It was definitely a painful exercise of learning these things, a couple of years back, but it's been quite some time. But yes, you enjoy this because this is an absolutely different kind of accounting. The kind of accounting, which we learned to become a chartered accountant was based on ICAI. It was a very different kind of accounting. And this particular accounting is just beautiful. Every day is a learning experience, trust me. Every day when you're talking about these standards, something new you're learning each day. The volumes which are written on these standards are interesting. So it's a learning experience every day because every kind of complex situations are arising. It's a wonderful experience. I love it. Okay, so let's now do one thing. I am going to take you to another interesting chart. And there is another interesting chart which is given in the study material. So I want to look at this chart, then I'll document some notes with you. So let's have a look at the chart which is given in the study material. Some very interesting charts are there in the study material as well. Okay, so when we look at the financial liabilities, it says amortized cost, where the interest is taken on the basis of EIR. This you already know. So when you consider the financial liability, I'm going to make a chart very soon on this now. So we can say that if there is a financial liability at AC, you need to apply the EIR concept. And related to this, you also know the concept of TC. You also know the concept of processing fee, which we have already discussed. That a TC would trigger EIR. The processing fees will trigger the EIR. Then it says FPTPL liabilities. So what do you do with the fair value changes? Now have a look at this. What is it talking of the fair value changes? Now watch this. It says, number one, unrealized gains and losses other than changes in the credit risk. Unrealized gains and losses for changes in own credit risk. Now don't get scared, just hear me carefully. The change in the fair value of the liability, please mind the words carefully. The change in the fair value of the liabilities designated at FPTPL will be split into two parts. The change in the fair value of the liability designated at FPTPL will be divided into two parts. What is due to change in the credit risk and what is due to other than a credit risk. So what do you mean by a credit risk? The credit risk means that there is a default in terms of payment. So when you say that there is a credit risk attached to the instrument, it indicates that there might be a default. So the company will have to divide the gain or loss relating to own credit risk and the fair value difference, which is other than a own credit risk. It says what is due to own credit risk will go to OCI. And it says the other portion is going to enter in the profit and loss account. And it says the realized gains or losses upon derecognition will be entered in the profit and loss account. So moral of the story, let me tell you that this is the area where FPTPL liabilities, you need to segregate the two components. You need to decide what is the gain loss due to own credit risk OCI and what is due to other than own credit risk is going to be entered in the P&L. So can you please summarize the entire aspects in a chart and elaborate? Let's begin. Let's do one thing. Let's make an interesting chart to you. So I guess let me just add out here. Let's now consolidate the learnings at this stage. Let's consolidate the learnings at this stage. So I am now going to make the classification of these liabilities at this stage. And Abhishek sir, are you teaching since 99 or even before? At least that one. Okay, that's great. And Shruti tells me, did you score a rank? Unfortunately not. Knowledge is one thing. And I think passing the exams, getting a rank is another thing. Passing and getting a rank is a different story. Getting knowledge is a different story. There are two different objectives. You need a different mindset to pass exams, get rank. You need a different mindset to get knowledge. I think I'm running after knowledge and not ranks at the moment. Okay, so let's, I think, begin with the financial liabilities with you. So you can start noting it down as well. So I'm looking at financial liability. I'm looking at financial liabilities. And in terms of financial liabilities, we can say, if you're looking at initial measurement and if you're looking at a subsequent measurement, if you're looking at an initial measurement and if you're looking at a subsequent measurement, the initial measurement is done at a fair value. And I gave you the exceptions, that there are two exceptions already given. Number one, it is supposed to be, you can say, a trades payable, and it is a loan which is payable on demand. So these are the two exceptions in terms of FL, and under these exceptions, it is measured at a transaction value. In this cases, it is measured at a transaction value. This is, I think, what you learned. Now, coming to the subsequent measurements, we can say the broad categories of FL. There are 5 broad categories in terms of financial liabilities from the subsequent accounting perspective. Number 1, so which are measured at AC, which is measured at amortized cost, that is AC, and this is the default category. This is the default category. So I have been discussing the concept of TC and the concept of processing fee also along with this. So just let me quickly rewind that concept as well. So in this particular case, if I'm looking at TC and I'm looking at processing fee, let's quickly rewind that what is the accounting treatment. In terms of FA, we added a TC. In terms of FL, we need to reduce the TC. And the moment you reduce the TC, it triggers the concept of EIR. In terms of the processing fees as well, it is going to be reduced from the fair value of the liabilities, and this will again trigger the concept of EIR. I've already covered that in the chart earlier. So when you go to consider your liabilities at AC, TC reduced from the fair value, processing fee reduced from the fair value, and that triggers the concept of effective interest rate. Okay, now comes the next aspect. It is liabilities which are measured at FPTPL. It is liabilities which are measured at FPTPL. In this particular case, there are going to be 2 liabilities. One is a liability which is held for trading. So basically, you can say held for trading would be something which is a derivative liability. So if you've got any kind of derivative financial liabilities, it is going to be taken at FPTPL. And the other one is supposed to be a contingent consideration. The other one is supposed to be a contingent consideration, and contingent consideration as per Ind AS 103. So you've already seen that contingent consideration. This is also measured at FPTPL, and this is the contingent consideration which is either payable in cash or it is payable in variable shares, not in terms of fixed shares. So there are 2 kinds of liability which are measured at FPTPL: derivative financial liabilities and contingent considerations, which is payable in terms of cash or which is payable in terms of variable equity shares. Now, in this particular case, if it is measured at a fair value, any changes in fair value is going to be taken in the P&L account. Any changes in the fair value is going to be taken simply in the P&L account. Now, let's come to the third category of liabilities. And the third one is which is designated. The third one is which is designated to be measured at FPTPL. It is designated to be measured at FVTPL. So originally, it might meet the AC category. Originally, it might meet the AC category, but I am going to consider and measure it at a fair value through profit and loss. So in this particular case, you can say, I guess, let me put it here. You will split the change in fair value between 2 components. You're going to split the change in fair value in 2 components. As I said, in this case, the change in the fair value entirely enters the P&L. But in this particular case, when it is designated, you need to split this into 2 components. One is, you can say, due to the change in fair value due to own credit risk. So there is a fair value due to own credit risk, and this is taken in OCI. And the other portion, which is the balancing figure, is taken in the profit and loss. So how would we able to calculate that what is the fair value change due to credit risk or how much is due to other factors? Well, there has never been a question in the exams on that area. I believe if it comes, they will tell you directly that this is the change in the fair value due to own credit risk, and this is the remaining fair value change. You should only know that the change due to credit risk will enter the OCI and the other portion enters the P&L. So in this case, the entire change goes in P&L, and in this case, it is split between OCI and the profit and loss. Therefore, they've got two different accountings in this case. Further, we are looking at the fourth one, and this is financial liabilities arising. Financial liabilities arising on, you can say, derecognition. Rather, I would say financial liabilities arising when derecognition. Don't get worried on this. Arising when derecognition of financial assets cannot take place. When derecognition of financial assets cannot take place. This we're going to talk tomorrow, so don't get worried on this. Don't even apply your mind at this stage on the fourth category. There will be certain financial liabilities which will arise because I'm not able to derecognize an asset, but I'm receiving money and I can't derecognize the asset, so I'll recognize the financial liabilities in this particular case. So this will be discussed later. And then finally, the fifth category is called FG, financial guarantee, not finished goods. It is called financial guarantee. And they've got a different measurement base. So this is what is called financial guarantee. This is called financial guarantee. So there is going to be a different accounting as far as FG is concerned. So now we've understood the accounting treatment of three categories, leaving the last two. So we have seen that if it is a case of AC, then in that particular case, you need to apply the EIR. No fair value changes will be captured. The processing fee, transaction fees, how it is accounted is all there with me. If it is FPTPL, fair value changes in the P&L. If it is supposed to be a designated FPTPL, split the fair value change and some portion in the P&L and some portion in the OCI. Forget about the financial guarantee and forget about the fourth category that we'll discuss. I think now let's have a look at least these two. We are not going to even cover questions on this area, not there. We're just going to cover these two kinds of financial liabilities. So let's have a look at AC and let's have a look at the other one. Mansha, so we're blessed to have you as a teacher. Thank you so much, Mansha. That makes my day as well. Thank you so much indeed. Okay, now I think let's have a practical look at the AC category and the FPTPL category as well. So let me now take you to a practical illustration in the study material. So let's have a look at the study material and let's consider a question on AC to begin with. Because we already know the accounting in terms of AC, so I think doing that is not a big deal because we already know the concept of AC. So let's see how the financial liabilities are taken at AC. We are on illustration number 31 in the study mat. It says A has borrowed from RBC Bank 10,000 at a fixed interest of 10%. There is a loan processing fee, which is paid 500 and the loan is payable after 5 years in bullet repayment. Bullet repayment means that there is going to be a payment in one go. So you're going to make a payment of interest every year, but the principal is going to be paid one go at the end of 5 years. The details of the loan is given. So this is the loan amount and the starting date and the repayment date is given. The interest rate is 10% and the interest is charged and paid yearly, and there is an upfront fee. This upfront fee is nothing but the processing fee, which is already talked of. How would this be accounted in the books of A? I think now it's going to be a simple affair. So unless I see clearly the question tells me that it is held for trading. Well, this is not a liability which is held for trading. And I think it's nowhere given in the question that it is designated to be FPTPL. So I think the default approach of AC would apply. The best way is to look at that if it is a derivative, a PTPL. If it is designated, the question is to tell me. So, which means that by default, we are looking at amortized cost approach. So the AC approach would apply. So when the AC approach will apply, and I told you something very clear, and I said, if nothing is given in the question, I have reasons to believe that the contracted rate and the market rate is same. Nowhere I'm given in the question that the contracted and the market rate is not same. So if it is the same, that means the transaction value and the fair value is same. So what is the value at which liability will be recorded? Let's, I think, give you a small leisure to begin with. So let's do one thing. Let's make a leisure account just to give you a clarity in terms of FL accounting. So let's take the financial liability leisure. Can I see the entry which will be done is bank account debit, FL gets a credit. So when you're going to put the entry bank debit FL credit, it will be fair value minus the processing fee. So what is the fair value? The transaction value itself is the fair value minus the processing fee. So you will record this at 9,500. By the way, there is a question coming in, and let me ask you, if you can answer this, then I think your concepts are going great. I can see that there is a processing fee which is given in the question. If there is a processing fee even in the question, will you be able to consider your finance charge at 10%, or are you going to calculate EIR? Let's get the answers from you. Let's get the answers from your side. Let's see, what do you say? I am given a processing fees in the question, and I'm given a 10% rate of interest. Will I be able to use that 10% in order to calculate a finance charge, or do we need to calculate an EIR? Let's get this. So let's get your inputs on that. Make your evaluations. You already know that a presence of a TC triggers EIR. The presence of a processing fee triggers an EIR, and that is rightly said. We need an EIR in this case. Wonderful indeed. Which means if I need an EIR, has he given me an EIR in this case? No, he's not given me an EIR. So I need to compute the new effective interest rate. Basically, you need to calculate an internal rate of return. And since you need to calculate an internal rate of return, what are you going to do? You are going to do interpolation. So I think let's take it further and show you the interpolation as well. So they have done the calculations of the interpolation. What they've done the calculations of NPV. They've done the calculations of NPV, and they have got, this is 11.42% is the new effective interest rate. And you can now imagine, when you reduce the processing fees from the initial amount, the outflow goes down. And if the outflow goes down, you know that the EIR will increase. You want me to calculate this EIR, or can I directly pick this 11.42? I think you got a choice. You want me to calculate this EIR, I can do the honors. And if you think you can manage it, then I'll leave that. So you can ask me, if you want, I can do the calculations of EIR quickly, or I can just pick up 11.42. Decide and let me know. Okay, so in the meantime, I think let's go back to the calculations in this particular case, and let's have a look at how the FL ledger is going to be prepared in this case. So you're going to consider a finance charge at the rate of 11.42%, because we will do the calculations at the new effective interest rate 11.42. So if you calculate on 9,500, 11.42, it comes to 1085. The payment which is made at the end of the year is at the contracted rate of 10%, which is 1,000. So this is made a payment at 1,000. You get a balance CD as a balancing figure, and that's how the ledger for the first year gets made. So this is going to be 9,500 plus 1085 minus 1,000. That comes to 9,585. And then in the next year, this becomes a balance BD. and the position will continue on for the next 5 years, absolutely on the similar lines. Okay, I think I didn't get any inputs on the EIR, so I believe that you'll be able to manage the calculations of the EIR. So this is how the accounting will continue on the basis of 11.42%, which is the effective interest rate. So this was one sample question on the calculation of the FL at amortized cost accounting. I think rest of the leisure you can manage. Okay, let's have a look further. And in this particular case, let's have a look again at another question, which is illustration 32. I'm not solving that illustration. I'm just going to make a run through. So that we are again able to identify how the accounting this is done. This is another very interesting question, because in this case, the examiner is more interested in checking your fundamentals, whether you are able to calculate the EIR, how good or bad you are in terms of AFM to calculate the effective interest rate as well. Okay, so let's, I think, have a look at illustration 32. It says A made a borrowing from RBC Bank at a fixed rate of 12%. The loan processing fee is 500 and it is payable in 4 half-yearly installments of 2,500 each. Oh my God. You know, in this particular case, since the loan is not repayable in bullet or annual payments, but it is payable in a 4 half-yearly installments, in this particular case, your calculations of IRR will be troublesome. Because in this particular case, when you go to calculate the internal rate of return, your inflows are taking place in between every 6 months. Let me tell you. In this particular case, if you visualize the cash outflow and if you visualize the cash inflow from the point of view of, you can say, the lender. So we can say he's paid a 10,000 loan and there is a processing fee which is 9,500. And if you look at the inflows in this case, you are getting 2,500. So there is an inflow at the end of first 6 months, then at the end of 1 year, then at the end of 1.5 years, then at the end of 2 years, and so on. The inflows are generated in the middle of 6 months every year. So you need to locate a present value factor, a discount rate at which the present value of all these inflow equals 9,500. And you'll have to calculate the EIR. So in this particular case, if I just take you to the calculations, the good thing is that if you notice in the question, they have been kind enough and they've given you what is the internal rate of return. You know, my piece of advice would be, if you want to get your concepts very clear and you want to practice a bit as well, try calculating the internal rate of return for this question. Try organizing the outflows and inflows and see what is the discount rate at which the present value of all the inflows equals the outflow, though it is already given. And I think this is an amortization chart. So what I'm going to do, I'm just going to quickly make a first year ledger just to be on a safe side. So let me do one thing. Let me just organize the ledger account just for a period of 1 year to go with, just that you get a basic feel of the financial liability which is being measured at AC, just the first year. So you're going to first of all record the entry at the initial recognition, which is at a fair value minus the processing fee, which is 9,500. Now we need to be careful because you need to accrue the finance charge for a period of 6 months and not on an annual basis. So what I'm going to do in this particular case, so you're going to consider the interest, and you know, in this case, what they've done, another interesting point is that the interest is charged on a quarterly basis. The interest is charged on a quarterly basis and the principal repayments are made in the middle of 6 months. So technically, when you go to calculate your internal rate of return also, trust me, you're going to get some money inflow 3 months, 9 months, then 1 year and 3 months, and then it is 1.5 year, then it is 1 year and 9 months, and so on. I hope you got the point. Because you would be getting the interest every quarter, the principal every 6 months. So you got different inflows, which is taking place 3 months, 6 months, 9 months, 1 year. So your calculation of the internal rate of return is going to be super duper hit. So this is now getting very, very heavy indeed. I can understand, but do practice these questions because I'm just giving you the larger concept. Okay, so let's, I think, just have a look at the leisure account. So what are you going to do in this particular case? You are going to accrue the finance charge at the end of 3 months. You're going to accrue the interest at the rate of 16.6% for a period of 3 months. Nothing is paid at the end of 3 months, mind you. The interest is getting charged, but of course, when the payments are going to be made, are you going to make a payments as well? Yes, we're making the payments as well. So the payment is made and the interest is paid at the end of the first quarter. But you can't close the ledger. This is the opening balance on 1st April. You accrue the interest for 30th June, and 30th June, the interest is paid. And then you need to again accrue the interest at the rate of 16.6% for the next 3 months. And you need to be careful that when you calculate this interest, it is taken on this balance. And when you're going to consider this interest, it will be taken on this balance. Every time you're going to calculate the interest, you're going to consider what is the outstanding balance at each stage. And you're going to accrue the interest on that balance. And then the payment is further made. And along with this, you also pay the principal amount as well at the end of 6 months. Here the interest is paid, but not the principal. So quarterly interest payments, but 6 monthly principal repayments as well. So be careful, and you can make this particular entire chart in the form of a leisure account as well. Wow. So FLAC is done. FLAC is done. Now let's take it further. FLAC is done. Now let's take it further out here. So this was FLAC. Okay. So this part is done. That is FL at the AC part is done. Okay. Now I'm just going to make a run through on a simple concept for the next 5 minutes with you. I don't want to take anything technical at this stage. FPTPL liability is not a big deal because changes in the fair values will be taken. So I just want to take a small little last concept with you, just a small little chart to begin with. And I think that should be, technically quite enough to digest, I guess. Okay, I think there are no further questions coming in. Everybody seems to be quite tired now. The mind is, got quite heavy indeed. Okay, I'm sure it does, but it's perfectly okay. Now, I want to make a quick chart on the financial liabilities. The way I made a chart on FA, I want to quickly make a chart on the FL as well. And in this case, I am only considering two parameters. I'm not considering designated at FPTPL. I'm just taking AC and I'm taking FPTPL. That's it. So let's take a mind map. Let's take a mind map on the financial liabilities in this case. So let's take a column particulars. And let's take if it is measured at AC and if it is measured at FPTPL, not designated one. So tomorrow I will be covering the two liabilities as well. One is financial guarantee and one is those financial liabilities which arises when a derecognition of FA cannot take place. So the two categories will be taken care. Now, if I begin with the first aspect, that what is the value at which initial measurement is done? What is the value at which initial measurement is done? I would put it like this, that it is fair value minus the TC. And it is also a processing fee if there is any. And in terms of this, it is simply fair value. If there is TC, it is immediately charged to P&L. It is immediately charged to P&L. Next, if I'm looking at a subsequent measurement, that means I'm looking at the fair value changes. That do we capture the fair value changes in this case? The answer is no. We do not capture any fair value changes in terms of AC. Do we capture the fair value changes? Yes, and that will be captured in the P&L. The gain or loss, whatever, is going to be captured in the P&L. Number 3, we need to consider whether EIR concept is going to be applicable. So in terms of AC, yes. In terms of FPTPL, no. And what are the types of liabilities which are going to be accounted in terms of AC? I would say FPTPL is derivative. FPTPL is basically derivative, or I can say those which are held for trading. And I would say this is the default category. This is going to be a default category because any liabilities which are not covered under FPTPL by default is AC. So all this will be covered in terms of AC. Okay, I think that seems to be good. Initial measurement is done, subsequent measurement is done, EIR is done, and the kind of liabilities covered is done. There is no question of profit or loss on sale of liabilities like the concept of FA. So we're not covering all that issues in this case. So that summarizes the treatment of accounting of financial liabilities. AC, FPTPL, I'm not worried on designated. I'm just worried on financial guarantees and those liability which will arise if a derecognition of FA cannot take place. Okay, so far so good. I think that seems to be quite good indeed. Well, let me see if there are more questions coming into your mind as well. Abhishek, sir, tomorrow you should give these questions for homework. So you should give these questions for homework, not today, but tomorrow, as we have enough time thereafter before the class number 8. Okay. Don't worry. Tomorrow you will be able to get a lot of questions which you will be able to do out of the study mat. We are right now on unit number 2. We have practically covered unit 1, partially the unit number 3, and we are on unit number 2. All these special agendas, what we need to cover, are there in terms of unit 3. Okay, so I think that seems to be quite heavy. I'm not giving anything further. So our accounting in terms of FA as well as FL is practically over. Now the only agendas of discussions is the 2 remaining FL and the special issues, which we're going to continue a journey tomorrow. But as I always say at the end of the class, that please make a cumulative revision of these standards. Typically, once you completed with the standard, do make a consolidated revision. And once you do that, trust me, you're going to feel very much confident indeed. Okay, so let's see if any questions coming on your side. Abhishek, so are we not going to study the designated FL at FPTPL? No. There is no practical illustration which is given in the study mat, which talks about how to segregate the fair value changes leading to the own credit risk or the other factors. So I've just theoretically given you that idea. We're not covering those accounting. So that's going to be very complicated. How to compute what is the change due to own credit risk. That's quite an interesting, though a difficult task as well. Right, so that is done. I think that seems to be all for the questions. Right, friends, so I think it's time to say goodbye to you. I'm going to join you back tomorrow with another interesting packed session on financial instruments. So good night to all of you. Thank you. Bye-bye and take care.